Hello everyone. You are watching Financial Management with Raveendra Hegde. Dear students, in this session, let us discuss two important issues: risk return trade off and organization of finance function. First, let us examine risk return trade off. A financial decision reflects risk and return aspect. Therefore, a financial manager, while taking any financial decision, should take into consideration returns expected and the magnitude of risk involved therein. Friends, market value of the shares depend upon the rate of return, and the rate of return is based on amount of risk run. The risk return trade off is an investment principle that indicates that the higher the risk, the higher the potential reward. An investment proposal yielding high returns is exposed to high level of risk, and low returns involve low level of risk. In the screen, you can see the diagram where cash and cash equivalents or fixed deposits in the banks have very negligible or very low risk with low return. But as far as derivatives or equity funds are concerned, they involve high risk along with the high return. It is quite possible that a financial manager, in his bid to maximize returns, may choose an investment proposal that may be exposed to high risk, that may or may not give expected returns. Friends, so proper balance has to be struck between returns expected and amount of risk involved therein. This balance is referred to as risk return trade off. Return should be commensurate with the risk assumed. An efficient finance manager should try to maximize the returns at minimum possible risk in order to increase the market value of shares. He should avoid unnecessary risk in respect of every financial decision like dividend decision, investment decision or financing decision and so on. To calculate an appropriate risk return trade off, investor must consider many factors including overall risk tolerance, the potential to replace lost funds and more. Students, this is about risk return trade off. Now let us move on to organization of finance function. You are seeing the organization chart on the screen. This organization chart indicates three levels of financial management, that is top level management, mid level management and bottom level management. Dear students, the top level management constitute board of directors and managing director or president. The middle level management includes finance manager or vice president or chief finance officer. In short, we do call as CFO, who is answerable directly to the president or MD, who in turn reportable to the board of directors. The treasurer and controller, what we can see in the bottom line, are working under the supervision of finance manager or vice president at the bottom level. The finance manager or chief finance officer, as may be called, has both line and staff responsibilities. In many cases, a finance committee is set up by the top level management people consisting the members of the board of directors. The finance manager is also included as one of the members of finance committee. The finance manager is concerned with the planning and control of funds, decision making, and also assisting the top management people in formulating plans, policies, programs, and so on. He has also staff responsibilities to be discharged, which includes supervision of the working of treasurers and controllers. So, this is the organization of finance function where you can see the chief financial officer or finance executive chart. The treasurer and controllers are work with the supervisor of chief financial officer, and cash manager and credit manager works under treasurer. The financial accounting manager, cost accounting manager works under the supervision of controller, and portfolio manager also work under the supervision of treasurer, whereas internal auditor works under the supervision of controller. Modern financial management has come a long way from the traditional corporate finance. As the economy is opening up and the global resources are being tapped, the opportunities available to finance managers virtually have no limits. A new era has assured during the recent years of CFO in different organizations to finance executive is known in different name. However, their role and functions are similar. His role assumes significance in the present day context of liberalization, deregulation, and globalization. Let me have a quick glance over the functions of Chief Finance Officer. Estimating requirement of funds, decision regarding capital structure, investment decisions, dividend decisions, cash management, evaluating financial performance, financial negotiation, and keeping touch with stock exchange quotations and behavior of share prices. Jeff Thompson, I am a president and CEO, says today's CFO team is expected to add value well beyond the traditional roles of cost management, controls, and acting as the consciousness of the organization. These roles are challenging enough, but today's CFO is expected to work in collaboration by serving as the integration hub for key business processes, as a catalyst for change, including business transformation, and as a consultant or trusted business advisor in helping to create sustainable growth. To sum it up, the finance executive of an organization plays an important role in the company's goals, policies, and financial success. His responsibilities include financial analysis and planning, finding the proper amount of funds to employ in the firm, that is, designating the size of the firm and its rate of growth. Dear students, the second important responsibility of finance executive or chief finance officer is investment decisions. Means the efficient allocation of funds to specific assets. The next one is the financing and capital structure decisions. That indicates raising funds on favorable terms as possible, that is determining the composition of liabilities. Next is the management of financial resources such as working capital, and finally risk management, that is protecting assets. Today, the role of Chief Financial Officer or CFO is no longer confined to accounting, financial reporting, and risk management. It's about being a strategic business partner of the Chief Executive Officer or CEO. The treasurer is responsible for managing the funds effectively. His responsibilities include estimating financial requirements, negotiations with financial institutions, monitoring cash flows, managing credit, floating securities, protecting funds and securities. In all, he looks after the liability side of the balance sheet. Just remember this, the treasurer looks after the liability side of the balance sheet. The functions of treasurers are forecasting financial requirements, means determination of total fund requirements, period for which funds are required, forms in which funds are to be collected. Second, management of cash flows, achieving balance between cash inflow and cash outflow so that a firm does not have any sources lying unutilized and ensure payment of creditors bill promptly. This also protects the solvency of the firm. The third function of the treasurer is maintaining relationship with financial institutions and investors, creating and maintaining market for companies' securities, maintaining contact with the investors, making borrowing arrangements from the bank and other financial institutions, establishing better relationship with them. And next one is management of credit and collection, indicates deciding on granting of credit and supervising the accounts receivable process. The fifth function is insurance coverage. Providing insurance coverage has may be necessary to protect the financial interest, protecting the assets of the company. Floating the securities, providing necessary information for floating the securities, managing the issues, maintaining the relationship with the stock market operators. Next is functions of controller. The controller is concerned with the management and control of assets. The controller is responsible for preparing financial reports, profit planning, corporate accounting, budgeting, inventory control, tax management, and so on. In other words, his functions relate to the asset side of the balance sheet. Again, let me repeat. The controller looks after the asset side of the balance sheet. Now let us discuss the controller's functions. The first one, planning and control. Providing necessary information for formulating financial plans and policies, profit planning, capital budgeting, accounting policies, dividend policies, and so on. This provides sound basis for financial control. Second one, preparation of financial reports and interpretation. Friends, preparation of financial statements and reports, interpretation of operational results by making ratio analysis, fund flow analysis, cash flow analysis, comparing actual result with budgeted results to find out any variations, submission of required reports to the government departments. Third one is inventory management, employing different measures of inventory control to ensure efficient inventory management. Fourth one, budgeting and budgetary control. Preparation of different types of budgets such as sales budget, production budget, inventory budget, cash budget, and so on, and ensure effective budgetary control. Fifth one is internal auditing. Friends, this means planning and supervising the internal audit system. Sixth one is the tax management. You know very well about this. Tax planning, compliance with taxation rules, provisions, and procedures. The seventh function is cost control. Use of standard costing techniques for cost control. And finally, protection of assets. Protecting business assets and property through internal control techniques and providing necessary insurance coverage. So today we have discussed about the risk return trade-off and the scope and responsibilities or functions of financial officer, treasurer, and controller. If you have any doubts, just drop a message to my WhatsApp number 974096350. I give the answers. Thank you so much. Have a nice time.